The stock market isn't just about $100 shares and household names. Some of the most interesting opportunities heading into 2026 may come from companies trading under $10, names that don't dominate headlines, but quietly sit at the intersection of major economic and technological shifts. Today, I am walking you through 3 stocks under $10 that analysts are watching closely as we move deeper into 2026. These are not hype-driven plays. Each company operates in a different sector, each faces real risks, and each has specific developments worth understanding. And make sure you stay until the end, because the third pick on this list might genuinely surprise you with what it is doing right now inside the global AI and infrastructure supply chain. Before we begin, a quick reminder: this is not financial advice. Everything here is an educational analysis based on publicly available information. Always do your own research and consult qualified professionals before making investment decisions. Why look at stocks under $10 in 2026? When people hear stocks under $10, they often assume low quality or excessive risk. The reality is more nuanced. Lower-priced stocks tend to include companies in transition, businesses that may be restructuring, repositioning, or operating in cyclical industries that temporarily fall out of favor. Heading into 2026, market conditions remain uneven. Interest rates, global trade policies, AI infrastructure spending, and digital advertising trends are all influencing capital flows. Large institutions often avoid smaller stocks because of liquidity constraints or mandate restrictions, not necessarily because the businesses lack merit. That disconnect is where opportunities and risks can emerge. Stocks under $10 can move quickly when sentiment shifts, but they can also fall just as fast. The key is understanding why a company trades at its current level and what might realistically change over the next 12 to 24 months. With that context, let us break down 3 very different companies under $10 that reflect 3 very different themes for 2026. Stock number 1, Nokia. AI-driven network infrastructure. The first stock is Nokia, trading in the $6 to $7 range heading into 2026. Most people still associate Nokia with mobile phones, but that business disappeared long ago. Today, Nokia is a telecommunications infrastructure company focused on 5G, network equipment, and increasingly, AI-enabled networking. What changed the conversation in late 2025 was Nokia's strategic partnership with NVIDIA. NVIDIA invested roughly $1 billion in Nokia, acquiring a minority stake while forming a deep collaboration around AI-native networking. The goal is to transform traditional mobile networks into intelligent systems capable of optimizing traffic using artificial intelligence. This partnership focuses heavily on IRAN technology, artificial intelligence applied directly to radio access networks, and early development of 6G infrastructure. Large carriers, including T-Mobile, are expected to begin testing these systems through 2026. From a financial perspective, Nokia is coming off a difficult period. Revenue declined in 2024 as telecom operators reduced spending. However, by late 2025, growth returned on a year-over-year basis, and management initiated a major restructuring to simplify operations and reduce cost. The company is targeting meaningful operating profit expansion through 2026 and beyond, driven by efficiency improvements and higher margin network infrastructure sales. Analysts currently expect earnings growth in 2026 if carrier spending rebounds and AI-related networking adoption accelerates. The upside case is straightforward if AI-driven networks become a real spending priority. For global carriers, Nokia stands to benefit as a core infrastructure provider, and it trades at a valuation far below most AI-related networking peers. The risks are equally clear. The telecom equipment market is highly competitive. Ericsson, Cisco, and other players are fighting for the same budgets. IRAN adoption is still early, and carrier spending cycles can be unpredictable. Nokia is a turnaround story, not a guaranteed winner. Stock number 2, Taboola. AI meets digital advertising. The second stock under $10 is Taboola, trading around $4 to $5. Taboola operates in digital advertising, specifically native and performance advertising across the open web. If you've ever seen recommended content at the bottom of a news article, there's a good chance Taboola powered it. Historically, Taboola was viewed as a native advertising company. That perception is changing. Over the past 2 years, Taboola has invested heavily in AI-driven performance advertising through its Realize platform, which allows advertisers to measure conversions, optimize campaigns, and target users across thousands of publisher sites. This matters because performance advertising is a much larger and more valuable market than traditional native ads. Heading into 2026, advertisers continue shifting budgets toward measurable outcomes rather than brand impressions alone. Taboola has partnerships with major media and technology platforms, giving it access to first-party data from hundreds of millions of daily users. In late 2025, the company announced expansions into connected TV advertising, with a broader rollout expected in 2026. Financially, Taboola is approaching scale. Revenue continues to grow, EBITDA margins are improving, and analyst earnings estimates for 2026 have moved higher. The stock trades at a valuation below many peers in ad tech, largely because investors remain skeptical about competition from giants like Google and Meta. The bull case is that Taboola successfully transitions from a content widget company into a performance advertising platform across the open web, an area where publishers want alternatives to walled gardens. The risk is execution. Digital advertising is brutally competitive. If advertisers don't see strong performance metrics from the realized platform, growth could stall. Profitability is improving, but consistency remains critical. Stock number 3, Gerdau Infrastructure and Industrial Exposure. The third stock is completely different. Gerdau, trading around $3. Gerdau is a steel producer with operations across North and South America. While not a technology company, Gerdau sits at the center of infrastructure, construction, automotive, and industrial demand, all areas receiving renewed attention heading into 2026. What reignited interest in Gerdau was U.S. trade policy. Higher import tariffs on steel have strengthened pricing power for domestic producers, and nearly half of Gerdau's earnings come from its North American operations. Financial results through 2025 showed improving margins, driven largely by U.S. demand and disciplined capital spending. Analysts expect capital expenditures to decline after 2025, potentially unlocking stronger free cash flow in 2026. Unlike many sub-$10 stocks, Gerdau pays a dividend, offering income alongside potential price appreciation. That dividend also acts as a signal of balance sheet confidence. The upside case depends on continued infrastructure spending, stable steel demand, and favorable trade dynamics. If U.S. construction and manufacturing remain resilient, Gerdau's earnings could surprise to the upside. The risks are macro-driven. Steel is cyclical. Economic slowdowns, changes in trade policy, or weakening construction demand could pressure margins. Gerdau's international exposure adds currency and geopolitical risk. Risks you should not ignore. All three of these stocks share common risks. Price volatility is higher. At lower share prices, execution matters more than narratives. Sector conditions can change quickly. Broader market sell-offs can impact all stocks regardless of fundamentals. None of these companies is our set and forget investments. They require monitoring, patience, and realistic position sizing. Nokia, Taboola, and Gerdau represent three very different stories under the $10 heading into 2026. Nokia is a network infrastructure turnaround tied to AI and next-generation wireless. Taboola is an AI-driven advertising platform trying to compete outside the walled gardens. Gerdau is an industrial play benefiting from infrastructure spending and trade dynamics. Lower-priced stocks aren't automatically bargains, and they aren't automatically traps either. The difference lies in understanding fundamentals, catalyst, and risk. If you found this analysis useful, like the video and subscribe for more deep dives into overlooked market opportunities. Drop a comment below telling me which of these three you'd like a follow-up on, or what sector you want covered next. Thanks for watching, and I'll see you in the next one.